So if you're a Tesla investor, or even if you're just watching the company from the sidelines, there's really one question that looms over everything else. It's the multi-trillion-dollar question that could either make Tesla's massive valuation make perfect sense, or, well, show that it's all just a house of cards.
Now, this question isn't just a what if. It's the absolute core of the whole robotaxi idea. And, it's pretty much the single biggest reason Tesla's stock has been valued so highly for so long. The concept itself is actually pretty simple, but the financial implications, they are just staggering.
And this is the number that has Wall Street completely mesmerized. $75 billion. Now let that sink in. We're not talking about the company's total revenue. That's the projected annual revenue from the robotaxi service alone by 2030, according to S&P Global. To give you some perspective, that's almost as much as their entire car business is expected to bring in that same year. All right, so in this explainer, we are going to unpack that $75 billion figure. We're going to break down the business model, look at the financial potential, and most importantly, we're going to weigh the very real risks from a long-term investor's point of view. We'll look at four main things: how the business model works, the money behind it, the competition and the risks involved, and finally, the big takeaway for you as an investor.
Okay, so first things first. How exactly is Tesla planning to turn millions of its cars into a global money-making taxi fleet? What are the actual mechanics?
Well, it all revolves around something called the Tesla network. The easiest way to think about it is like Uber or Lyft, but with one absolutely game-changing difference. There are no drivers. And that right there represents a huge pivot for the company, from the one-time sale of a car to a continuous stream of high-margin service revenue. Now here's where it gets really interesting. Tesla plans to build this fleet in two ways. First, they'll have their own fleet of cars that they own and operate, and they'll keep all the revenue from those. But the second model, and this is the one that's a potential game changer, is an owner-operated fleet. If you own a Tesla, you could add your car to the network when you're not using it. You earn passive income, and Tesla takes a commission.
Elon Musk's analogy here is just perfect. It's about turning a car from something that just depreciates in your driveway into an asset that can actually earn you money. And from a business perspective, this is the key to scaling the network incredibly fast without Tesla having to pay for every single car itself.
All right, let's get to the numbers. Because for an investor, a great idea is one thing, but it's the math that really has to work. So let's dig into the core figures that make this so compelling to Wall Street.
This single number is the bedrock of the entire financial case. Less than 20 cents per mile. That's Tesla's target cost to operate an autonomous ride. And how do they get there? Well, it's pretty simple. You remove the single biggest expense of any taxi or ride-hailing service, the driver.
And this is where you really see the disruptive power. You take that 20-cent target and you put it next to the roughly $2.50 per mile it costs for a typical Uber or Lyft ride today. All of a sudden, you see the potential for absolutely massive profit margins. Or you could just drastically undercut all the competition on price.
And this chart from S&P Global really shows you what that could look like. It's projected to start pretty small, maybe $1 billion in revenue in 2026. But as the fleet grows and the tech gets better, it's forecast to just explode to $75 billion only 4 years later. That is the hockey stick growth curve that investors are betting on.
So, as you'd expect, Wall Street is paying very close attention. Now you have famously bullish firms like ARK Invest, who see Robotaxi as over half of the company's future value. But what's really telling is that even more traditional banks like Morgan Stanley and RBC are factoring in tens of billions in future revenue from this. It's a huge reason their price targets are so high.
But, and this is a big but, Tesla is not walking into an empty field here. An opportunity this big attracts some very serious competition. And in many ways, Tesla's actually playing catch-up. Just take a look at this snapshot of the race. You can see right away that companies like Waymo, that's Google's project, and Baidu in China are already operating thousands of vehicles across multiple cities. Waymo's already completed millions of paid, driverless rides. So based on what's on the road today, they look to be years ahead of Tesla's small pilot program. So if they're behind, why do the bulls think Tesla can still win? Well, it really comes down to four key advantages. First, they have a massive data lead from the millions of cars already on the road feeding their AI. Second, they build everything themselves, the car, the chip, the software, which helps control costs. Third, they can update everything instantly with over-the-air updates. And finally, their ability to manufacture cars at scale is just unmatched. The bet is that these advantages will let them scale up faster and cheaper than anyone else when the time is right.
Okay, so that's the bull case. But as any responsible investor knows, you always have to look at the risks. The road from a small pilot program to a $75 billion business is full of some pretty major obstacles.
There are really four big ones to watch. First up is regulatory approval. Getting the green light from city after city, state after state, is a slow and really unpredictable process. Second, the technology itself has to be proven safe in every possible scenario, not just a sunny day, but in a blizzard or a chaotic construction zone. Third, the competition isn't just standing still. Waymo is already building a customer base. And finally, you have to remember that those huge financial forecasts are based on assumptions that might just not pan out.
And this quote from an analyst report really brings us back to earth. It's a great reminder that no matter how good the model is, we are talking about projections for a business that doesn't even really exist yet. These are not guarantees.
So let's bring it all together. What's the bottom line? What should a long-term investor take away from all of this?
The main takeaway is this. Robotaxi is the definition of a high-risk, high-reward proposition. And it is absolutely crucial to understand that a huge chunk of that potential reward is already baked into Tesla's stock price today.
So for your portfolio, it breaks down like this. The bull case is that Robotaxi succeeds and Tesla becomes this amazing high-margin AI and mobility company. The bear case? The project gets bogged down by delays, competitors capture the market, and the growth story that supports the stock just kind of deflates. So the key for you is to watch for real execution. Ignore the hype and focus on tangible progress like regulatory approvals and the actual performance of the service in early cities.
And that brings us to the final, most important question you should be asking yourself. Autonomous taxis are coming. That seems inevitable. The trillion-dollar question is whether Tesla can get through all the red tape and scale its unique technology faster than competitors who are already on the road signing up customers today. The answer to that question is what will likely define the next chapter for Tesla.